This is what $15 billion of debt looks like when the party is over. For 2 weeks, the Olympics are a symbol of human excellence. We see the peak of athletic performance, the unity of nations, and the triumph of the spirit. It is designed to be emotional. It is designed to make you feel something. But for the host city, once the torch goes out and the cameras leave, the emotion fades. And what is left is almost mathematically guaranteed to be an economic death sentence. Today, we are strictly removing the emotion. We are performing a forensic audit on what the data suggests is the worst recurring business deal in the history of sports. We are going to find out where the money actually goes. Welcome back. Most people look at the Olympic Games and see gold medals and world records. But if you look at the balance sheets, you see something entirely different. You see a pattern of systematic capital destruction that would land any private CEO in prison. I'm Mugada Siva Ganesh. I spend my life deconstructing the financial machinery that runs the world. And today, we are not looking at sports. We are looking at sovereign debt, infrastructure liabilities, and the optimism bias that destroys economies. We are going to audit the books of 3 specific cities. One that paid for its mistake for 30 years, one that collapsed an entire national economy, and one that actually made money. By the end of this video, you will understand exactly why buying a liability and calling it an asset is the oldest trick in the book, and how the smart money ensures they never make that mistake. To understand why this happens, we have to start with the auction. This is where the game is actually lost, not on the track, but in a conference room in Switzerland, 7 years before the first race is run. Imagine an item that has an objective intrinsic value of exactly $10 billion. Now, imagine 3 people bid on it. The first bids $8 billion. The second bids $10 billion. The third bids $12 billion. Who wins the auction? The third bidder, the one who bid $12 billion. But note what just happened. The winner is invariably the person who overestimated the value the most. In economics, this is called the winner's curse. The theory was first formalized in the 1970s by engineers claiming oil fields in the Gulf of Mexico. They found that whoever won the drilling rights usually ended up losing money, because to win the bid, they had to be more optimistic than everyone else about how much oil was down there. The Olympics is the ultimate winner's curse. It is a blind auction with uncertain value. When a city bids for the Olympics, they aren't buying a finished product with a fixed price tag, like a factory or a company. They are signing a contract to build massive, unique infrastructure on a deadline that cannot be moved. The International Olympic Committee, or IOC, holds a monopoly. They are the sole seller of the Olympic brand. The cities are the buyers. And because there are usually multiple cities competing for one slot, the IOC has all the leverage. They demand what is effectively a blank check. The host city agreement typically includes a government guarantee. This is a legal clause stating that if costs overrun, and they always do, the local taxpayers cover 100% of the deficit. The IOC takes zero financial risk. So why do smart politicians sign this? Because they aren't bidding with their own money. They are bidding with yours. The incentives are misaligned. The politician gets the ribbon-cutting ceremony and the global prestige today. The debt bill arrives 10 years later, long after they have left office. This is a classic principal-agent problem. The agent, the politician, takes the reward, while the principal, the taxpayer, takes the risk. Once the bid is won, the track snaps shut. Now the city typically has 7 years to build infrastructure that would normally take 20. In the construction world, there is a simple triangle of constraints: good, fast, cheap. You can pick 2. If you need it good and fast, it will not be cheap. But the Olympics adds a 4th constraint: the deadline. If you are building a normal highway or a normal airport, and you run into a delay, maybe bad weather, or a labor strike, or a supply chain shortage, you push the completion date back 6 months. It costs money, but it is manageable. You cannot push back the Olympics. The opening ceremony is on a fixed date. The whole world has booked their flights. Depending on the contract, the TV rights holders would sue for billions if the broadcast is delayed by even an hour. This creates zero negotiation power for the host city. Think about it from the perspective of a contractor. If you know the city must finish the stadium by July, and it is currently May, you can charge whatever you want. If the steel workers go on strike a month before the games, you pay them double, triple, whatever they ask. You have no choice. This is why Olympic projects have a unique inflation profile. According to the most comprehensive data available, from Professor Bent Flivbeard at the University of Oxford, the Olympics have the highest average cost overrun of any type of mega project in history. Not just sports. Any project. Bridges, tunnels, dams, space missions. The Olympics are worse than all of them. The average cost overrun is 156% in real terms. Let me repeat that, 156%. That means if a politician looks you in the eye and tells you the gains will cost 5 billion, the statistical probability, the base rate, suggests it will actually cost nearly 13 billion. But they never use the base rate. They rely on optimism bias. Optimism bias is the psychological tendency to underestimate the likelihood of negative events. Local officials convince themselves that this time it's different. They convince themselves that their city is smarter, more efficient, less corrupt. They feed these optimistic numbers into economic impact models to justify the bid. They claim that the tourism boom will pay for everything. This is the second great lie of the process, the tourism multiplier. The projection is that millions of tourists will flood the city, spending money in hotels and restaurants. The reality is often the opposite. Academic studies consistently show that regular tourists, the people who would visit Paris or London anyway, actually avoid the host city during the games. They do not want to deal with the traffic, the security checkpoints, and the inflated hotel prices. So the normal tourists stay home. They are replaced by Olympic tourists. The total number often essentially stays flat, or increases only marginally. But the city spent billions to get them there. This displacement effect is rarely calculated in the bid. They count the gross revenue of the Olympic tourists, but they do not subtract the lost revenue of the normal tourist who stayed away. They are counting the assets, but ignoring the opportunity cost. The projection is a fantasy. The debt is real, and no city learned this lesson harder than the one that started the modern era of megadebt. We are about to look at the disaster of Montreal. This is the case study that terrified the world. But stay tuned, because later in this video we are going to expose the one exception. The one city that defied the IOC, refused to sign the guarantee, and actually made a profit. It is crucial to observe their model, because it is the only way to win a rigged game. But first, we have to go to Canada, 1976. The year is 1970. Montreal wins the bid for the 1976 Summer Games. The mayor, Jean Drapeau, was a visionary, but perhaps not a mathematician. He famously declared, "The Olympics can no more have a deficit than a man can have a baby." Well, to use his analogy, Montreal ended up having a very large, incredibly expensive baby. The plan was ambitious. The centerpiece was the Olympic Stadium, nicknamed the Big O. It was designed by a French architect, Roger Talabert. It was meant to be a masterpiece of modern engineering, featuring the tallest inclined tower in the world and a complex retractable roof. The initial budget for the stadium was $134 million. But almost immediately, reality set in. First, the unions realized they had the leverage we discussed earlier. There is a fixed deadline. The construction workers went on strike multiple times. Costs skyrocketed. Second, the design was incredibly complex to build in the harsh Canadian winter. The technical challenges were underestimated at every turn. By the time the games opened in 1976, the roof, the signature feature of the stadium, was not even finished. It wouldn't be completed until more than a decade later. But the bills were finished. The final cost of the stadium was over $1.1 billion. This was in the 1970s. That is roughly equivalent to 5 or 6 billion today. For one building. The deficit for the games as a whole was roughly $1 billion. The city of Montreal could not pay it. So they took out a loan, a 30-year loan, to pay for a 2-week party. The provincial government had to introduce a special tobacco tax to service the debt. Every time someone in Quebec bought a pack of cigarettes, they were paying for the 1976 Olympics. The debt was so massive that the citizens of Montreal did not finish paying it off until November 2006. Think about the timeline. A child born during the opening ceremony in 1976 was 30 years old, perhaps with children of their own, before his city finally cleared the balance sheet for an event he doesn't even remember. This is the definition of intergenerational theft. The politicians of 1970 spent the future earnings of the workforce of 2000. And what did they get for it? The Big O is now often mockingly referred to as the Big O. The roof has torn and malfunctioned multiple times. It costs millions just to maintain. It is a classic white elephant, an asset that costs more to keep than it generates in value. Montreal was a financial disaster, but it was contained to a city. Our next example didn't just hurt a municipality, it helped to destroy a nation. If Montreal was a cautionary tale, Athens was a horror story. In 2004, the Olympics returned to their birthplace. It was an emotional moment for Greece, a moment of national pride. But as we know, emotions are the enemy of good accounting. Athens had a problem that Montreal didn't have. On September 11, 2001, the world changed. Security protocols for major global events were rewritten overnight. When Athens won the bid in 1997, the security budget was estimated at a modest sum. But by 2004, the cost of protecting the games had exploded. The security budget alone was over $1.5 billion. That is more than the entire cost of some previous games. They had to install a C4I surveillance system, command, control, coordination, communication, and integration. It was military-grade tech. Patriot missiles were stationed around the city. A blimp with surveillance cameras hovered over the Parthenon. It was a war zone disguised as a sporting event. But the real tragedy wasn't the security, it was the white elephants. Greece is a small nation. It has a population of about 11 million. It does not need a world-class softball stadium. It does not need a massive kayaking slalom center. But the IOC requires specific venues for every sport. So Greece borrowed cheap money. Remember, they had just joined the Eurozone and had access to low interest rates, and built 22 specialized venues. Softball fields, kayaking centers, taekwondo halls. Once the athletes left, these venues became useless. You cannot turn a kayaking center into a shopping mall. You cannot turn a softball field into an apartment block without tearing it down. They sat empty, rotting in the sun. And here's the part that hurts the most. Even when they are empty, they still cost money. You have to pay for security to stop vandals. You have to pay for basic maintenance so they don't collapse. It is estimated that maintaining these ghost structures cost the Greek taxpayers nearly $100 million a year after the games ended. While the Olympics didn't single-handedly cause the Greek financial crisis of 2010, economists agree it was a major contributing factor. It added billions to a national debt that the country could not service. They spent money they didn't have, to impress people they didn't know, to buy things they didn't need. Montreal paid for 30 years. Athens paid with its economic sovereignty. But in this sea of financial ruin, there is one exception. One city that looked at the IOC's bad deal and said no. To understand the solution, we have to go back to 1984. After the disaster in Montreal, nobody wanted to host the Olympics. It was radioactive. For the 1984 Games, the IOC only had two bidders, Los Angeles and Tehran. Then, due to political instability in Iran, Tehran dropped out. Los Angeles was the only option. It was a monopoly of one. This flipped the power dynamic completely. Usually, the IOC has the leverage. No, LA had the leverage. The city of Los Angeles passed a law forbidding the use of taxpayer money for the games. They said, we will host it, but we won't pay for it. The IOC paid it. But they had no choice. They agreed to a contract that did not include the government guarantee. Enter Peter Uberroth. He was a businessman, not a bureaucrat. He ran the 1984 Games like a private corporation. His strategy was simple. Use what you have. The IOC requires an Olympic stadium. Montreal built a new one. LA used the Coliseum, which had been built in 1923. The IOC requires an Olympic village. Montreal built a billion-dollar complex. LA used the existing dormitories at UCLA and USC. The students were on summer break, so the rooms were empty. Cost to build? Zero. Uberroth aggressively commercialized the games. In Montreal, there were hundreds of sponsors, but they contributed very little money. Uberroth limited the sponsors to a select few exclusive partners, Coke, McDonald's, GM, and charged them millions for the privilege. He lays out the blueprint for the modern sports business model. The result? The 1984 Los Angeles Games didn't just break even. They generated a profit of over $225 million. It remains one of the few Summer Olympics in modern history to turn a significant profit, and certainly the most efficient. The lesson here is profound, and it applies to every business and every investor watching this. When one buys assets, like existing stadiums, they win. When one buys liabilities, like building a kayak center in a desert, they lose. LA showed that one powerful way to win the Olympic game was to break from the IOC's traditional rules. So if the blueprint for success exists, why doesn't everyone follow it? Why did Athens and Rio and Sochi go back to the Montreal model of spending billions? Because while the city loses money, many of the people running the project do not. We have to follow the money one level deeper. We have to look at the private profit, disguised as public loss. The loss is public. The profit is private. This is the matrix moment. You realize the system isn't broken. It's working exactly as designed. It just wasn't designed for you. Construction companies secure government-backed contracts. Developers see property values rise with new infrastructure, and consultants earn hefty fees for bid proposals, whether or not the stadium ever fills. For these groups, the Olympics are less about sport and more about channeling public money into private hands. Most people look at this transfer and see corruption or bad luck. I see a mechanical process. The truth is, most of you are trading blind. You obsess over stock tickers and technical patterns, but you ignore the operating system that dictates who wins and who loses. That is why I built the Applied Macroeconomics course. This is not a get-rich-quick scheme. It is a professional-grade briefing on the architecture of money, from central banking to sovereign debt. If one wants to stop being a passenger in the global economy and start understanding the machine, they must study the blueprints. The objective is to stop playing the game and start engineering it. The link to the course is in the description. Now there is one final piece to this forensic puzzle. If the financial return on investment is often negative, why do countries like China, Russia, or Qatar spend billions they will never get back? Because sometimes, the goal isn't profit, it is power. In 2008, Beijing didn't spend $40 billion to sell tickets. They spent it to tell the world, we have arrived. In 2014, Russia spent $50 billion on the Sochi Winter Games, the most expensive in history at the time, to project strength. Qatar spent an estimated $200 billion on the World Cup infrastructure. This is called soft power. For emerging superpowers or authoritarian regimes, the Olympics often serve as a global commercial for their system of government, a way to buy legitimacy, treating debt more like a marketing expense than a financial burden. Is it worth it? For the regime, maybe. For citizens whose hospitals and schools are underfunded to pay for empty stadiums, the answer is usually no. So what is the lesson for you? You aren't running a country. You aren't bidding for the 2036 Games, but you face this same Olympic trap every single day. We are constantly tempted to buy prestige, flashy cars, expensive clothes, impressive job titles. We think they are investments. We think they signal our value to the world. But often, they are liabilities. They are what I call personal white elephants. The aspiring sovereign, the individual who thinks like a nation-state, does not fall for the winner's curse. We do not overpay for hype. We do not confuse activity with productivity. We do not sign contracts where we take all the risk and someone else gets all the reward. We act like Los Angeles in 1984. We negotiate, we leverage what we already have, and we demand a return on our capital. The aspiring sovereign functions as the CEO of their own life. They ensure their ego never writes checks that their future self can't cash. Since you've stuck around till the end of this audit, it's clear that you found this deep dive intriguing. I think you'll definitely want to check out the videos popping up on your screen now. They explore even more fascinating topics in the global financial machine that might just challenge your perspective. And if you enjoyed this video, I invite you to like and subscribe for more content that breaks down complex and foundational topics in finance. Thanks for watching.